Okay, let's start. I think Good morning, good afternoon, and good evening to everyone. Welcome to the seventh edition of our Commodity in Focus webinar series. My name is Hemant Bansal, and I'll be your host for today's webinar. As a means of a short introduction, I'm based in India and currently heading the Commodities Intelligence team at the Smart Cube. I've been at this space for more than 12 years now, and my current responsibilities include, managing all our clients across three core sectors, which is CPG, life sciences, and industrials, with respect to their commodity inflation or volatility management needs. I'm also joined by my panelists Anuj and Nancy. They specializes in metal market and are closely monitoring all developments, happening around green energy transition. And they will be talking about their analysis as to how they expect metals market will behave both in the short term and in the long term in the backdrop of green energy transition. So let's quickly look at today's agenda first. What first we will talk about what are the most critical materials needed for energy transition and why this transition is going to be metal intensive. Then we are also going to talk about, what are the key metals to monitor, how is their supply situation matches up with the demand for this transition to happen, and what are some of the probable supply risk associated with these metals. We will also then talk about the long and short term price outlook for these transition metals. And lastly, we are going to look at some of the strategies that you can apply to mitigate some of the impact on your business. Towards the end of the session, we will also, leave some time for question and answers. So therefore, throughout the webinar, request you to keep posting your questions in the Q&A box, which you will find at the bottom of your screen so that, everyone can see them and upvote them as well. So yeah, all right, let's start and I'll hand over the mic to Anuj. Anuj, over to you.
Thanks, Evan. The energy transition is a global shift towards cleaner and more sustainable energy sources to mitigate climate change. In the next slide, we will explain why this transition will be highly metal intensive and also explain why metals are essential for achieving our renewable energy goals. Expanding wind farms, solar power plants, and other renewable energy sources requires large quantities of metals for infrastructure and equipment. The shift towards electric vehicles demands significant amounts of metals for battery production, including lithium, cobalt, and nickel. The transition to decentralized energy systems, including rooftop panels, microgrids, relies on metals for the installation and interconnection of these systems. Aging grid infrastructure needs upgrades to accommodate increased renewable energy capacity, resulting in higher metal demands. Implementing energy efficient technologies like smart grids, efficient motors, and lighting systems also requires metals for their production. Metals such as copper, aluminium, and steel play an important role in building and expanding electricity network. Copper, which is highly conductive and corrosion resistant, make an ideal material for electricity wiring and transmission cables. Energy storage is a key enabler for renewable energy transition and grid stability. Lithium ion batteries, widely used in electric vehicles and grid scale energy storage, rely on metals like lithium, cobalt, and graphite. In conclusion, energy transition towards a sustainable future heavily relies on these critical metals, from copper and aluminium in electricity networks to lithium, cobalt, and nickel in energy storage. These metals are essential for powering the renewable energy revolution. In the next slide, we can see that the demand for clean technologies is expected to surge over the next 2 decades. According to recent estimates, mineral demand from clean energy technologies is projected to increase by 4 times by the year 2040. This tremendous growth in demand can be attributed to electric vehicles, battery storage, and expansion of electricity network to accommodate renewable energy sources. Now, let's try to understand which metals are the most critical for energy transition. In the next slide, we highlight the importance of each metal required for different energy transition technologies. EVs rely on advanced battery technologies for efficient and reliable energy storage. These batteries require significant amount of minerals including lithium, cobalt, nickel, and copper for their production. As the adoption of EVs accelerate worldwide, the demand for these metals is expected to skyrocket. The expansion of renewable energy sources such as wind and solar power necessitate a robust electricity network infrastructure which requires a substantial amount of metals. The growth in electricity networks to support renewable energy integration will significantly contribute to increasing demand for these metals. Let's now deep dive into the projected global demand for metals comparing the year 2040 to the current situation in this slide. This comparison highlights the magnitude of the mineral demand surge anticipated in coming decades. As you can see in the chart, the demand for lithium, a key component in EV batteries, is expected to grow exponentially, with estimates suggesting a more than 40 times increase by 2040. Cobalt and nickel, which are essential for battery chemistries, are projected to experience a significant demand growth, surpassing current levels by almost 20 times. Copper is also expected to witness a surge in demand as electricity networks expand to accommodate renewable energy generation. As we look ahead to 2040, the mining industry will play an important role in meeting the soaring demand for these critical metals, ensuring their responsible extraction and fostering sustainable supply chains. The projected global demand growth for metals clearly highlight the transformative impact for the clean energy transition and the need for strategic planning. In conclusion, copper, lithium, and nickel are one of the major critical metals for the energy transition. In the next slide, we will be discussing the supply risk for these metals. As you can see in the charts, we have provided the risk ratings based on fundamental factors, that is, supply demand deficit, environmental and sustainability factors, resource nationalism in major countries where these are produced, and supply concentration. Based on this risk rating, all four of these metals are at a high risk for supply disruption. Moving on, let's take a look at each of these factors, starting with resource nationalism in the next slide. Resource nationalism refers to the trend where resource-rich countries assert greater control over their natural resources. It involves various policies and measures aimed at maximizing state control, increasing government revenue, and ensuring local benefits from resource extractions. Major producers of these metals, Chile, Peru, DRC, and Indonesia, have introduced several measures such as regulations, taxations, increased royalties, export restrictions, leading to supply disruption and higher prices. In the next slide, we can see that both extraction and processing of these four metals is highly concentrated, with the top three producing countries accounting for more than 50% of supply. This regional supply demand imbalance will lead to a fierce competition to secure supplies of these metals. By 2033, Europe and the US will each contribute 5% to global supply versus 18% and 23% respectively of global combined electric vehicle demand. The supply concentration amid rising resource nationalism and geopolitical tension poses a greater threat to regional supply disruptions. Now, the obvious answer to the rising demand of these metals is to increase production and develop new mines. However, the development of new mines of these metals often involve energy intensive processes including extraction, processing, and refining. These processes, combined with the use of fossil fuels, result in substantial greenhouse emissions, primarily carbon dioxide and methane. In this slide, we highlight the average greenhouse gas emissions from mining of these metals. Lithium extraction involves various methods, including open pit mining and evaporation ponds. These processes consume substantial amount of water and energy, leading to significant emissions, particularly if the energy comes from fossil fuels. Emissions from extracting lithium from lithium hydroxide, which is expected to be the primary method of lithium extraction, are expected to triple to those extracting the lithium from lithium carbonate. Cobalt mining is also associated with both underground and open pit operations, often involving energy intensive processes such as grinding and smelting. Additionally, the artisanal mining sector, which contributes a significant portion of global cobalt supply, often operates with limited environmental regulations, leading to increased emissions. Nickel mining and processing, particularly for nickel pig iron production, can have significant environmental impacts. Addressing the rising emissions from new mines require a multifaceted approach that involves technological advancements, renewable energy integration, and sustainable practices, leading to higher cost of production and may limit the growth of production. Let's now deep dive into the fundamental supply, demand, and price outlook for each of these metals. Starting with copper, copper market is expected to be in surplus in coming years 2024 and 2025, driven by new mines expected to start operation in Chile and Peru. Another source of supply in the short term is from a large amount of copper stored at Congo's TFM mine, which was not exporting the metal for the last 8 months due to a dispute between its shareholders. Now, the dispute has been settled and we expect supplies to resume shortly. However, the supply growth is expected to slow down from 2025 onwards, and the copper is expected to witness a supply deficit of 3.5 million tons in 2030. One of the major reasons for slowdown in production growth is declining copper grades in existing mines, as the easily accessible high copper grades are depleted. Mining operations have to extract ore with lower copper content. This leads to increased energy and resource inputs, resulting in higher cost and environmental impact per unit of copper produced. Another challenge is the limited number of significant new copper mines discoveries in the recent years. Explorations have become more challenging and expensive, making it harder to identify and develop new copper deposits. This lack of new discoveries put additional pressure on existing mines to meet the future demand, potentially leading to supply deficits. Now, the social and regulatory risks are also a predominant factor in the copper industry. Mining operations often face community opposition, protest, and environmental concerns, which leads to project delays, increased cost, and reputational risk. Additionally, involving regulations related to environmental standard, labor practices, and indigenous rights add complexity to project development and operations. Copper mining projects require substantial investments, and the industry faces challenges related to capital inflation. Rising cost of labor, equipment, and infrastructure can also impact the economic viability of these projects. Consequently, some of the projects may be deferred or scaled back, further affecting the long-term supply outlook. Now, moving on to the short-term price outlook, we expect copper prices to remain elevated for the rest of 2023 due to production deficit in the year despite the looming recession and weak macroeconomic sentiments. Several producers, including Anglo American and Glencore, have downward revised their production guidance for 2023 due to protests in Peru. Further, anticipation of a decline in Chile's copper output in 2023 amid low water availability due to severe drought in the region is likely to keep the copper prices elevated. Further, on 17th May, Chile's lower house approved a new mining tax reform bill that is likely to put a heavy tax burdens on major producers in the country. Under the proposed change, the tax rate is expected to increase by 4 to 5 percentage points for copper exporters as compared with the current tax regime. However, the continued weak macroeconomic sentiments on account of rising concerns regarding the US banking sector will limit any significant price rise. Further, anticipated increase in US dollar index on account of a rise in interest rate by the US Fed in its May meeting is also expected to keep the prices in the range bound. In 2024, we forecast the copper prices to increase with improvement in demand with possible rate cuts in the US and Europe. However, the monthly average prices are expected to remain below the historical high level of $10,250 per ton due to a rise in production. Now, coming to the long-term price outlook, we forecast prices to increase gradually and reach a level of 12,500 in 2030. Now, one of the major reasons for the price increase is prolonged deficit from 2025 onwards. Growing demand for copper, particularly from emerging countries, and the renewable energy sector is projected to outpace the supply growth. This sustained deficit can put upward pressure on copper prices. The demand for copper is expected to surge in the long term, driven by electrification of transportation and the expansion of renewable energy infrastructure. Electric vehicles, grid scale energy storage, and renewable power generation projects require significant amounts of copper. The increasing adoption of these technologies globally is expected to drive substantial growth in copper demand. However, one of the key risks to be considered is the potential imposition of higher export taxes on copper producing nations. Some of the countries, such as Chile and Peru, have recently discussed or implemented plans to increase taxes on copper exports. These policy changes can impact the cost structure of copper production and potentially disrupt supply dynamics, leading to a price volatility. Another challenge for the copper market is the extended lead times required for developing new mining projects. Discovering, exploring, and developing new copper deposits often involve complex processes and significant investments. Obtaining permits, addressing environmental and social concerns, and securing finances can contribute to the lengthy project timelines, which can limit the quick ramp up of the new supply. So, in conclusion, the projected prolonged deficit driven by a surge in copper demand, along with risk associated with the potential higher export taxes and higher lead time for the new mining projects, can lead to a price increase in the long term. Now, my colleague Nancy will explain the outlook for the other key metals, lithium, cobalt, and nickel. Over to you, Nancy.
Thanks, Anuj. Now, let's start with the fundamentals of lithium. As you can see on the chart, lithium market is projected to remain in surplus till 2027 due to projected 33% growth in production over 2022 to 2025 time period. This production is actually led by rapid growth of lithium projects in China, particularly the integrated hard rock projects. However, if we look beyond 2027, the lithium market will likely witness deficit from 2028 onwards, primarily driven by the fast adoption of EVs and hence a rise in lithium-ion battery demand. Whereas on the supply side, the concentrated lithium resources within a few countries, such as Australia, Chile, Argentina, and China, can lead to geopolitical risks and political supply disruptions. Also, the regulatory framework and policies related to lithium extraction, production, and trade can impact the availability and cost of lithium. Not only these, but another key challenge in the undertaking new lithium project is high lead times, as lithium projects require significant investments, environmental assessments, primitive processes, and community engagements. Any such delay in the project development can create supply constraint and impact the lithium market. Overall, due to the mismatch in supply demand profile, there will be a competition to secure the lithium supply to meet the downstream demand. In conclusion, the fast adoption of EVs, geopolitical risks, possible delay in new lithium projects, and fierce competition to secure supply are the key dynamics shaping the lithium market. With these threats in the lithium market, now let's have a look at the price outlook. Starting with the short-term expectations first. Lithium prices have seen a sharp drop in first half of 2023, which is evidently visible on the price chart. This drop was majorly driven by bearish market sentiments generated by the end of subsidy of Chinese government on the purchase of electric vehicles. To give you some context, Chinese government had approved subsidy on EV since 2009. which came to an end as of 31st December 2022. Looking ahead, the prices are expected to increase in the second half of 2023, majorly because of three reasons. First, rebound in demand for China after the ease in its COVID-19 restriction policy. Second, a boost to demand will be provided by the proposed 6B emission standard in China, which is likely to increase the sales for emission-free EVs. And lastly, from the supply side, there are concerns regarding lithium supply from Chile, which is the second largest producer globally. As on 21st April 2023, Chile announced the plan of nationalization of lithium resources to exercise state control over the lithium assets. This is anticipated to reduce the private sector's interest towards lithium mining in the region, thereby having an adverse impact on the global lithium supply. Now, even though we are expecting an uptrend in the prices in the second half of 2023, the price levels are expected to remain significantly below the peak witnessed in 2022, as electric vehicle sales in China are expected to remain lower, from 95% last year to 22% this year. Further, weak macroeconomic sentiments and continued rise in production in 2023 will likely limit the sharp upward movement in prices, as global lithium production is foreseen to increase approximately 30% in 2023. Now, having talked about the short-term price outlook, let's move on to the key drivers expected to shape up the long-term price outlook for lithium. The fast adoption of EVs is likely to be the significant driver for lithium demand and has a direct impact on the prices. As we have already discussed above, EVs will be responsible for over 80% of the global lithium demand by 2030, and this surge in demand is likely to outpace the supply growth, leading to a supply deficit. Another key driver that will influence the lithium prices will be the resource nationalism. Countries with substantial lithium reserves, such as Chile, Argentina, and Bolivia, may implement policies and regulations to ensure local value addition and retain more benefits from their lithium resources. These measures, such as export restrictions and increased royalties, can create supply uncertainties and potentially drive up the lithium prices. The various challenges involved in lithium mining and processing, as discussed earlier, can limit the timely expansion of lithium production capacity, leading to potential supply constraint and making it difficult to meet the expanding demand, and will likely exert upward pressure on the prices. Lastly, geopolitical risks, including changes in trade policies, political instability, or trade disputes among the lithium producing nations, can impact the availability and prices for lithium in long term. Now, move on to the next section where we will be talking about the fundamentals for nickel, which is another important metal for this transition. Currently, the nickel market is in a surplus and projected to remain in surplus till 2027, supported by ample production. However, the market is likely to mark a deficit from 2028 onwards, as demand growth is likely to surpass the growth in production from 2025. On the supply side, nickel production is likely to grow 57% during 2022 to 2030, supported by new projects in Indonesia and projected expansion of refining activities in China. On the demand front, the likely growth in stainless steel and EV industry to support the projected 72% increase in demand over the same period. The deficit projected in nickel market will be highly tilted towards the Class 1 high purity nickel, as demand for Class 1 nickel is projected to grow at a faster pace, with a rapid increase in battery demand and adoption of electric vehicles. Another important factor which poses geopolitical and supply risk in the nickel market is its concentration of resource. For mined nickel, Indonesia and Philippines accounts for approximately 50% of the total production, whereas refining is majorly done in China and Indonesia. Additionally, lack of significant discoveries of nickel sulfide ore, which is high purity nickel used for EV battery, is likely to give more weight to the class 1 nickel. To summarize, high deficit in class 1 nickel, increasing stainless steel and battery demand, and geopolitical risk are the key factors likely to impact the nickel market. Now, let's have a look at how all these factors are expected to impact the price outlook. Starting with the short-term trends first. Similar to the trends in lithium prices, nickel prices have declined in early 2023, driven by a combination of subdued demand in China, improvement in supply from Indonesia, and the decline observed in coal prices. Further, a projected surplus in nickel market in 2023 also extended the support to the price fall. However, production cuts implemented by Nornickel, which is a major producer in Russia, due to planned repair of flash smelting furnaces, limited the price fall. Going forward, we expect prices to increase driven by a rebound in demand from China and US. Chinese demand is likely to pick up, supported by ease in its COVID-19 restriction policy, and the demand from US is likely to improve in line with rebound in its automobile industry. China and US cumulatively accounts for 60% of the global nickel consumption and are likely to drive the price uptrend. Another key factor which will support price momentum is the historically low levels of nickel inventories at the LME warehouse. Overall, the price during 2022 to 2023 and 2024 is expected to remain lower than the peaks observed in 2022, which was driven by the supply constraints from Russia following the Russia-Ukraine war and from Indonesia due to the exports ban. Projected over 200,000 tons of surplus in nickel market during this period is likely to keep the levels range bound. Moving on to the long-term picture for price expectations. The likely growth in stainless steel demand and fast adoption of electric vehicles is a significant driver for nickel demand and has a direct impact on its prices. Projected 72% growth in nickel demand during 2022 to 2030 is likely to surpass the supply growth of 57%, with major pressure on class 1 nickel and higher upward pressure on the prices in long term. Overall, the nickel market will experience a deficit of 243,000 tons in 2030, supporting the average price levels of more than 35,000 per ton. Further, considering the energy-intensive and environmental damaging production process, there will be significant pressure on cost of production, driven by high energy prices and rise in environmental regulations. As already mentioned, lack of significant discoveries of nickel sulfide ore, which comes with potential capital inflation and likely project deferrals, are significant risks which can drive the upward movement in the prices. Summing up, the major factors seems to be responsible for nickel price uptrend will be shortfall of supplies in long term, rising cost of production, increasing awareness towards the healthier environment, and potential risk of capital inflation and project deferrals. So, majorly summing up nickel, next we will be moving on to the another important metal, which is an important metal for energy storage and hence a crucial metal for this green energy transition. Let's have a look at the fundamentals for cobalt. With a boost in production in 2022, the cobalt market is currently in surplus. which is expected to continue till 2029, and then followed by a very small deficit, or rather, we can say almost balanced market in 2030. The major growth is because of the upcoming new mines and increase in mining capacity in Indonesia. Going forward, the volume of surplus is likely to drop in long term as increasing awareness towards ethical mining practices and move away from artisanal mining will limit the supply growth. On the other hand, cobalt demand from EV sector is projected to grow significantly in the upcoming years. Currently, EV accounts for 40% of the total demand, which is likely to grow to 67% by 2030. Even though the market seems to have ample product availability to meet the rising demand, the concerns that are there in the cobalt market is driven by high uneven spread of its reserve at a global level. DRC accounts for 70% of the total mine supplies and have a high influence of the global cobalt market. Further, negative impact of mining activities on environment and society will inject risk towards the projected supply growth and current expectations of a balanced market. Keeping in mind these factors, let's have a look at the price charts and expectations. The Chinese government's action of removal of subsidy on EV purchases, as discussed over the lithium price outlook, have also pushed the prices for cobalt lower in the past few months. The downtrend was further supported by a likely 21% rise in production in 2023. Alongside, the improvement in availability post removal of export ban placed on mines in DRC also extended the support to the trend. After observing a downtrend till May, prices are expected to rebound going ahead in line with an expected improvement in demand for EVs. China is likely to implement its 6B vehicle emission standard from July 2023. To add more context, 6B emission standard applies to fuel and gasoline powered light vehicles and prohibits the use and sale of vehicle with high pollutant emission than the set standard, and thereby this could lead to an anticipated rise in demand for EVs. Further, because of declining cobalt prices since Jan 2023 due to low demand, new cobalt mines in the US have delayed their startup from April 2023 to the second half of 2023, citing poor profitability concerns. It is likely that these concerns might lead to further delay in the new plant startup, which might limit the growth of supply in rest of 2023 and may support a rise in prices. However, continued weak macroeconomic sentiments and ample supplies are likely to limit any significant rise in price. Let's move on to the long-term trends for cobalt. We expect the prices to gradually gain momentum and rise in long term after an expected decline in 2023. With a rise in stricter emission standard across major economies and increasing commitment globally to move towards a greener technology, a substantial growth in cobalt demand is projected in future. Cobalt supply, on the other hand, remains in surplus in 2023 and is expected to continue to remain in surplus over the coming years, with its high level to be achieved in 2025 and a projected decline in surplus there onwards, pushing the prices upwards. With the growing global demand for EV industry, geopolitical risk from highly concentrated production units, adverse social and environmental impact of cobalt mining, and other common risks towards capital inflation and deferrals in expansion, the prices are likely to observe bullish sentiment and show an uptrend in the long term. As we have discussed the major challenges for the key metals for the green energy transition, I would now like to conclude with the top 4 challenges that we should plan for in long term, along with the key recommendations to assure swift operation, supply security, and mitigating key risks. The most concerning overall challenges are resource nationalism, sustainability targets, investment and new mine discoveries, projected supply deficits. We have deeply looked into it and suggest starting with the long term planning from an early stage to secure your position in the upcoming situation, which is going to be full of challenges. This will require a continuous monitoring of inflation, not just for these metals, but also for the end products. We need to closely track the evolving demand supply fundamentals, policy changes by different economies, and changing cost structures for these metals. Another key suggestion will be strategic supply partnership. Implies partnering with suppliers to boost manufacturing capacities and assure supplies, even in a deficit market situation where there will be fierce competition to secure supply. Supply chain resilience via redesigned networks and improved supply management can also support the long term security. Having said that, alongside having multiple supply sources within and across region is also a good idea and can be important element to deal with the geopolitical risks. Lastly, flexible business planning and execution. With the help of scenario planning, effective, effective execution, and innovation budgeting will also be required to maintain a strong position in the upcoming challenging market. So, with these are the major factors we expect you guys to have a look. And with concluding this, I think Hemant, you would like to add a few bits here.
Thanks, Nancy. Thanks, Anuj, for these insights. I hope everyone you find it useful. So I'll just now open the floor for the Q&A, and I think we have received a couple of questions. So the first question is, I think, what's the outlook for battery demand over the next decade? Anuj, would you like to take that?
Yeah. So we expect lithium-ion battery demand to increase at a CAGR of almost 15% over the next decade, and with EV sector being the major driver of this demand, and we expect the EV to account for almost 80 to 85% of lithium-ion battery demand, over the next 10 years.
Okay. The next question is, any lithium battery alternatives that may disrupt the industry at a later stage? Anuj.
Yeah, so the vanadium redox flow batteries are, which use vanadium electrolyte liquid solution, are considered the main alternatives to the lithium-ion batteries, which can, see increased usage. And further, the LFP batteries, with the higher manganese content, may also witness higher usage in the future due to their higher energy density.
Okay. Thanks, Anuj. This one is for you, Nancy, I guess. If we project a high deficit for class 1 nickel and better availability for class 2 nickel, why can't we transform class 2 nickel into class 1 for battery usage? Nancy, you're on mute, sorry.
Sorry. So the transformation from class 2 nickel to class 2 from class 2 nickel to class 1 nickel is possible, but the transformation requires a process which have a very high greenhouse gas emissions, and hence considering our approach for a sustainable and green transition, this will not be suggested.
Okay. Next is this is done. Copper prices recently dropped below $8,000 per ton. Why do you think prices will remain elevated in the short term?
Yeah, so copper prices actually fell to almost $7,900 per ton in the last week. However, this was a momentary fall, and prices have again jumped to $8,100 per ton yesterday, right? And we expect prices to remain on the uptrend as we anticipate the US Fed's rate hiking cycle is almost over, and we don't expect any additional rate increase in the second half, and this will lead to a fall in the US dollar index, and which will again exert upward pressure on the copper prices. Additionally, we anticipate Chinese economic to recover in the second half of 2023, which will boost the demand for the refined copper and will tighten the copper market.
Okay. Next one is how government policies by major economies is expected to shape metals supply and demand.
Yeah, so several major economies like US, Canada, EU, have formulated their policies, to transition to a green or sustainable future. And some of the policies are, for example, for the US, they have introduced the US Infrastructure Investment and Job Acts, which is a $1.2 trillion package, to support millions of jobs, and it also addresses the climate change and grid safety. And additionally, they have introduced the Inflation Reduction Act and incentives for EVs. And this is again, aimed at giving incentives, to manufacture EVs, and which will again lead to a rise in demand for these metals. Similarly, if you look at the EU, they have introduced a law, EU fossil fuel car phase out, which is an agreement between the EU countries and private sector to to achieve 100% cut in carbon dioxide emissions by 2035. And this will effectively prohibit the sale of new cars and vans powered by the fossil fuels in the bloc after 2035. Whereas such laws and policies by different government will shape the demand for EVs and batteries, and again for these metals, right? Whereas various policies by the producing nations like DRC, Chile, Peru, with respect to taxations or royalties, will lead to supply disruption.
Okay, great. So we have like two more questions before we end up this session. So I'll request everyone, if there are more questions, if you have more questions, please keep on posting these in the Q&A box. So the next one is Anuj, Nancy. We have talked about supply deficit in the long term. So is there scope of lab grown metals to ease some supply pressure? Any view on this?
I guess there can be scope of these easing the pressure. However, we think those are still at an initial stage as of now.
Okay. I think the last question, I'm not sure we have a view on this or not, but to truncate GHG emissions, CCUS technology is pivotal in nature. So how the infrastructure of CCUS will affect the demand of metals?
Um, Carbon storage, carbon capturing and storage infrastructure does require substantial amount of metals. However, we don't have exact data to talk about now.
Perfect. Okay, I think these were the questions that we have. I think we can wait for one more minute. If anyone has any more question, please post it in the Q&A. Otherwise, we will wrap this session in a minute, and I hope you guys found it useful. Okay, I think there's no more questions. So thank you everyone for joining us today to talk about the metals outlook, to talk about the green energy transition. Thank you for your patience and have a nice day ahead. Thank you.